Welcome to the Broken Pie Chart Podcast, episode number 65. I'm your host, Derek Moore, and today I'm going to be talking about, did crude oil, really go negative? In other words, could you actually have been paid money to take a barrel of oil? Seems like a no-brainer, right? Well, not so fast, and we'll sort of explain why or why not. But the big news, last week was one of the days. And I'll explain how these contracts works and things like that. But on April 20th, crude oil, and this is the West Texas Intermediate, or the WTI, actually settled for the day at negative $37.63 a barrel. Whoa, how is it even possible? Getting paid to take something. Why wouldn't somebody just take it? And the price of oil at some point theoretically should go up. So that happened. And, I see a lot of stuff in the news. I see a lot of stuff on TV and people, just talking online. In fact, I heard from a few people asking me, hey, should I buy this? Should I buy some of this oil, or maybe the USO, which is an exchange traded product? So first of all, what you were hearing about is what's called the West Texas Intermediate Contract, or WTI. And so WTI is a little bit different than what's called Brent. And so West Texas Intermediate, it's basically, Brent is more the North Sea, and that's, Norway and things like that. And also OPEC bases their oil on the price of Brent crude. West Texas Intermediate is more from oil fields in, Texas, Louisiana, North Dakota, more landlocked type of deal. But it's similar, and sometimes the spread between one or the other gets out of whack or widens or narrows, but essentially that's what you're looking at. And when we talk about this idea of futures contracts, so if you take a look at futures contracts, there's always something called the near month or the front month. The front month is the one, if you watch CNBC, that's the one that they quote. So even though oil went negative for the front month, which was the May contract, which actually expired, I believe it expired the 21st or 22nd of April, so it didn't actually trade into May. That's the one that you saw. That's the one that went negative. The back months or future months did not go negative, although certainly oil is down. So to kind of paint the picture, and then I'll start to get into how is it that somebody would pay somebody in theory to take barrels of oil off their hands. I'll explain that. And then what kind of is going on there? Well, commodities are really a good example of supply and demand. And people buy and sell commodities for any number of reasons. They can speculate on the price. But you also have people who say, look, I'm going to need this product in X amount of months. I'll buy a futures contract in that month, and then I'll take delivery of it. Or I'm a seller. So if you're a farmer and you're farming wheat, you might say, I think my wheat harvest is going to be ready next November. So I'm going to go ahead and sell that contract now because I like the price. And then come November, I'll just deliver that contract. So if we look at crude oil, the West Texas Intermediate, WTI, right now, the June contract is trading $17.18. But if you look at the July contract, it's $21.35. You go out all the way out to January of 2021, and that's $29.49. So what does that mean? Well, if you were to, let's say, buy this front month contract and then delivery, so that it's a June contract, but it actually stops trading in May. And so let's say you bought this contract. What does that mean? It means that you're essentially buying one contract is equal to 1,000 barrels of oil. So one contract is equal to 1,000 barrels of oil. And let's say you buy that at $17.18. Not going to get into how futures trade and the margin. You don't actually have to put up all the money for that. And by the way, don't start trading futures if you don't know anything about it. I've gotten some text and some emails, and if you don't know what you're doing there, probably not a good idea. But you buy this contract, and that gives you the right at the end of the contract to take physical delivery of 1,000 barrels of oil if you're the buyer of it. If you're the seller of contract, basically you've agreed to deliver the oil, 1,000 barrels of oil at the end of that contract. And again, the June contract will stop trading sometime in May. So basically, when you use a futures contract, you're sort of locking in the price you'll pay, or you're locking in the price that you'll sell. And if you're a commercial operation, you might use this, because you like the price and you're like, oh, I'll be able to deliver at that. You also could use this to hedge. So, for example, airlines, although they're not necessarily pumping, light sweet crude into their tanks, it gets refined into jet fuel. The price of jet fuel does have a high correlation to the price of oil. So you could have people who hedge, meaning they might buy futures contracts to hedge against the price of oil going up and thus affecting the jet fuel. And you also have people who just speculate on the price. They say, look, I think oil is going to go down or it's going to go up, so I'll either short the contract or buy the contract, and I want to try and make money on buying or selling the contracts. And that's an important point, because you don't necessarily have to take physical delivery. You don't actually have to deliver. So as long as you can sell, or as long as you sell the contract prior to the contract stop trading, you don't have to deliver, nor do you have to take delivery. All right. Of course, there's also options on futures, but so when we look at oil, and typically what happens is prices are in what's called Contango. And that's just a fancy way for saying that the price on the front month is usually a little bit less than the next month, a little bit less than the next month, and so on and so forth. And part of that is it takes into account sort of the storage cost. It also could take into market factors like, you think oil is depressed now, but you think demand will rebound at some point. When it flips, and when you see the front month or the near month price be higher than the back months, that's called backwardation. And that's another phenomenon. And that actually, I'm going to write myself a note because a lot of people are asking me about USO, which is an exchange traded product. I'll sort of explain what they do, what they hold. They're actually holding front month futures and then rolling them at some point to the back months. But it's either in Contango or it's in backwardation. And so if you buy this contract, and if you take physical delivery, one contract is equal to 1,000 barrels of oil. And I remember a number of years ago, I had to take my Series 3, that's the commodities exam. And one of the things I learned was the size of a contract, and I assume this is still the case, but the size of one contract for a commodity was basically as much stuff that you could fit into a rail car. So if you're buying bushels of wheat, whatever the frozen orange juice, concentrate, you're buying sugar, you're buying coffee, you're buying barrels of oil. The size of the contract is based upon how much you can fit in a rail car. So one of these contracts, a WTI, is equal to 1,000 barrels. And so if it's trading at, $17, and in theory, when you take delivery, you'll pay $17,000 for these barrels of oil. All right. So, and so, by the way, when price goes negative, that also implies, if it's negative $30, it means in theory you're paid $30,000 to take delivery of this. Now, again, the key there is if you bought it at 17 and then it goes to negative 30, well, you agree to pay 17, right? So it's what you buy it at. So one of the reasons why I talk about the size of these contracts is that I got texts from people and I got some notes for people. And it's always interesting when something crazy happens with commodities. People have never traded commodities like, hey, why can I just buy a barrel and store it in my garage? There's actually a funny article, I'll link to it in the show notes, from Bloomberg. I think it was Tracy Alloway or somebody else, but she had posted it on Twitter. And the funny article was, remember that time we actually tried to buy an actual barrel of oil. And, one of the things you have to understand is you can't just take barrels of oil. Number one is if you own a contract, you're taking 1,000 barrels of oil. And just think about the size of a rail car. That's how much oil. But the thing is, you can't just store that anywhere. There's environmental laws. There's and if you look at that article, one of the things you realize is that holding the oil, it could actually be very harmful. It could seep odors or different things. If you inhale ethyl alcohol vapors, it causes one thing. If you inhale hydrogen sulfide, you could actually be killed. So the point of bringing this up is you can't just take this stuff and put it in your garage. So typically what happens is if you were to take physical delivery of oil, and I don't pretend to know everything about this market, but generally the idea is Cushing, Oklahoma, is they have a huge storage facility. And so let's say you were going to take physical delivery of this oil, you would actually pay to store it in this facility in Oklahoma. And I guess there's different prices, like if it's accessible to a rail car, if it's accessible to a boat, there's different prices. Again, I don't pretend to know about that market, but it costs you something to actually store it. And one of the things, there's an article recently that basically they're 76% full at that storage facility. And the other part, what the article was saying is that even though it's not fully leased, a lot of that has already been agreed upon to be leased. So right now there's ships on their way to the U.S. filled with oil, and they may have to, to store it there. And so, taking physical delivery of oil is you've got, safety, environmental. You can't just store it anywhere. There's sort of strict rules on it. And then, by the way, if you're just some random person who's going to take oil and store it, like, what do you even know about getting rid of it? Like, who do you sell it to and things like that? So that's part of why a lot of people, I think there were a lot of Google searches said, can I buy a barrel of oil? I'll link to that article. I think you'll find it interesting. But anyway, so what happened in the oil market? Well, as we know, there's not much demand. Not a lot of people are driving. There's the whole stay-at-home order right now. So we've had a little bit of a demand shock. And apparently there's not a lot of place to store it, not a lot of appetite for it right now. And so back on April 20th, you actually had that was a Monday. The near-month WTI contract closed at $18.27. And then the next day it closed at negative $37.63. And we don't know exactly all that came out of that. Who that was and things like that. The USO, I saw some reporting, and actually, from my perspective, it was incorrect. So USO is an exchange-traded product, and what they do is they'll hold the near-term, at least it was designed to hold the near-month futures, and then at some point, they actually roll out of those. So, for example, they own the Mays, and then in their normal course of operation, well before the last day of trading, they actually start to move out of those. For example, the June contract, they'll start to move out of them. I think I saw May 5th. So they own, let's say, the Mays, and then they go and they roll. And so with an oil contract, you could buy it, you could sell it, and you either have a profit or a loss there. You could take physical delivery, or you could do what's called a roll. And a roll is kind of a simultaneous where you sell the front month and then buy at the same time the back month. And a lot of people pointed to USO as being the reason why all this selling pressure came in and oil went negative. As far as I can tell, that actually wasn't the case because they were out of their May contracts prior to April 20th. And in fact, they have actually, instead of just going to June, I think they have 20 or 25% now in July, which is different than they've been doing. And then I think May 5th, somewhere around there is when they start to roll forward. But and a lot of people ask too, is USO, is that a good vehicle if you want to sort of speculate on the price of oil going back up? Here's the thing. It's, there's more to the product. It doesn't just track one for one, like whatever the price of oil is. Essentially what that's looking to track is you're holding the near month contract. And at some point, you've got to go and roll to the next month's contract, and they may change, do they go out 1 or 2 contracts now? It looks like they're going to go out some 1, some 2. But one of the things that you look at there is the Contango has been a little more extreme, meaning the price between the front months and the back months is wider. So if you're perpetually selling the front month and then paying more for the back month, you've got this erosion. And so it's not a product that I've used, and so I want to caution people. If you're going to do something like that, you really want to understand what it is they're holding. But I just wanted to make the point. As far as I can tell, it was not USO that was selling a lot of those contracts. It is worth noting too. The next day it closed at 10, and I think it kind of went back up. So anyway, part of the thing too is this idea of why is it that you could actually be paid to take a barrel of oil? Like, that doesn't make sense. But here's the thing, and I'm going to give an example. It's kind of a silly, ridiculous example. But imagine that you bought a couch, you bought a futures contract for one couch in June of an Ikea couch. And so imagine this. You're like, hey, I think I'll, maybe you're traveling and you plan to move into a new apartment. And you're like, I really like this couch. I'm going to take delivery of this couch. So I'm not going to I don't think my intention is not to buy a contract at 100, which means I'm paying 100 and I'll take delivery in June. My intention is not to buy and sell the contract because I think the price of a couch is going to go up. But of course, if you're a speculator, that's what you might do. You might say, I think the price is going to go up. So I'll buy the contract. I never want to take physical delivery. I'll just sell the contract if it goes higher. Or if I want to bet against it, I think, hey, I think the price of a couch is too high. It's going to go lower. I can short the contract and then buy it back cheaper, much like you would short a stock. But let's imagine that you pick this couch out. It's one of those Sweden, right? Ikea's in Sweden. Yeah, so nice looking Swedish couch. You buy the one contract and the deliverable is one couch. Of course, remember, it's 1,000 barrels of oil, but for our purposes, keep it clean here with just one couch. And let's say that it comes to June and you're stuck on the road and you haven't gone into an apartment. But if you don't sell this contract into the market, it's going to require you to take physical delivery. And so all of a sudden you're like, well, all right, well, I guess I can store it, but you call around and your friends won't take it. You don't actually have an apartment. You were supposed to be living in the apartment, right? But it's not ready yet. So you're on a business trip and you've got this couch that's going to come. Well, the couch is going to come, and where do you store it? So then you call around, you find out, well, there's a storage unit, and the storage unit's a small one. Great, that sounds good, but it's $50 a month. And so now you got to take delivery of this couch. You pay $100 for it, and then you have to pay $50 a month. And maybe it's going to take a couple months to get into the apartment before you can get it. Well, you're actually losing a lot of money there. And so maybe at some point you're like, it's just going to cost me. It cost me $50 a month, and I'd be better off just dumping this couch or whatever I can to avoid having to store it and pay, because in the long run that will be more expensive. And that's hopefully that makes sense. But it's like that's sort of why, in theory, someone's like, oh, I have to take physical delivery of this oil. If I don't sell or roll the contract, and maybe, they didn't have enough money to roll it because of the pricing difference. But if I don't sell out of this contract, I just got to sell it because I can't take delivery of these 1,000 barrels of oil. Then I got to go find storage. Maybe there's no storage. And unlike a couch, which you can put in a friend's garage, you can't put barrels of oil, much less 1,000 barrels of oil in somebody's garage. And so you can sort of quickly see how there could be some pricing dislocation there. And exactly who it was, and was it a hedge fund or was it somebody else? I mean, I think that those types of details at some point will come out. Somebody will do a post-mortem on this. But it's the whole idea of taking that physical delivery. And in the IKEA couch example, of course, it's silly. Well, imagine that one contract, by the way, is 1,000 couches. You're like, well, what am I going to do with 1,000 couches? So you sort of start to see the idea with that. So when we think about oil or any commodity, remember that in the end, it's about supply and demand. And if you have people that absolutely can't take delivery, what are they going to do? Well, they got to roll forward, which might require more money because there's a difference between what you're selling the front contract for and what you're buying the back contract. But also, you do not want to take delivery. Can't do it. No place to store it. Pay too much. Something like oil, you've got all sorts of regulations, and then how the heck do you sell it? By the way, and that's if you bought something. Let's say, imagine if you were buying, rubber futures, which trade on the Japanese commodities exchange, and those are coming in from, Indonesia or something like that. You've got to hire space on a tanker and have your, they take, I don't know how it's rubber trees and they take whatever the commodity is. Anyway, you kind of get the idea. So I know it sounds crazy. Like in theory, wow, I could be paid to take delivery of barrels of oil, but hopefully you see it's a lot more involved than that, but it is a great example of supply and demand. It's a great example of showing what a demand shock. And then you've got all this product that you've got to store someplace, and you can't just store it anywhere. So I'll link to in the show notes to the Bloomberg article. It's kind of funny, and it's they say the time they actually tried to buy a barrel of oil and realized it was actually quite dangerous to store, more dangerous than I even thought. I'll also link to a page which shows the current futures chain, which means the different months that you can look at the futures price and things like that. So hopefully this was instructive, and I've gotten a lot of questions on it, and I don't pretend to know everything there is to know, or much to know about storing physical oil, but I do know that if there's no space and it's a product that requires some special handling. And by the way, the size of the contract, as you can see, you don't just buy a barrel of oil. In this case, one contract is 1,000 barrels of oil. So good luck storing that somewhere. Anyway, we'll be back next week. As always, please, instead of wasting time rating, reviewing, starring, go ahead and share this with somebody that someone that might be, enjoy it. And keep the feedback and the questions coming. You can go to razorwealth.com. Use the contact me site, and a lot of suggestions. Like I had some suggestions this week to do an episode on how it is or why somebody wouldn't want to take a physical barrel of oil, be paid. Because remember, in theory, when it went to minus $20, in theory you could be paid $20,000 if you bought it when it was plus 30, it doesn't mean you get it at minus 30, right? If you actually went on there and bought the contract. But it was only there for a little bit. All right, folks, we'll call it good for now. We'll be back next week, and please share this with someone that you know. Talk to you soon.